Welcome to the show today. Tax, our attitude towards it, is highly correlated to the amount of it that we pay. Recently, and without any chance for consultation, the New Zealand government implemented new rules which will change the amount of tax to pay when you sell a property that's not your primary home, or when you alter the ownership of it within a 10-year period. Additionally, further proposed legislation, if passed, will cease the ability of those in the business of renting out residential properties to claim interest as a tax-deductible expense. Now, what used to be referred to as a standard accounting principle is now being called a loophole. Now, for background, many reserve banks around the world have been keeping interest rates low and intend on keeping them low for longer. This creates some side effects, specifically asset inflation first, like with share marks and property, and consumer inflation later. Low rates lead to greater inequality as those with assets race ahead to success, apparently at the expense of those who don't have assets behind them. So, a workaround to offset this inequality in the form of higher taxes is required. Will it be successful in fixing a housing crisis in New Zealand? That's a really important question to ask here. Another question, though, is what other side effects could follow as a result of taxing more those who are simply trying to seek above average for their retirement? Amanda Martin is a specialist tax advisor, and we're talking today about what these changes actually mean for property owners and how they could have a much larger impact than what everyday people may initially appreciate. Now today, to say that these tax changes are just another tinkering of rules around the edges, it's not. To say that this only affects the wealthy, it won't. These changes are significant, but more concerning than these sudden new changes is that it could be symptomatic of a larger trend with government that we all need to wise up to. Now, back to today, one last thing. I've had a few conversations with property investors in the last few weeks around this topic, and the greatest trend that I've observed, especially with smaller scale property investors who have perhaps 2 to 3 properties, is that they don't fully appreciate the impact this tax could have on their cash flow. So what I'd suggest is that if you think that this may affect you in some way, engage your professional advisors sooner rather than later, all to make sure that you've factored this into your longer term financial plan. Please don't act on any of the material that we're covering today then, because some of the finer points of these new rules haven't yet been fully fleshed out, and further clarity will come in due time. So before we start, please be sure to check out Hatch. Hatch is my broker of choice for any US-based share investing that I do, and if building a long-term investment portfolio on your own is something that you're keen to make a start on, then check out the referral code in the description, where if you start a new account and deposit an amount of $100 or more in New Zealand funds, you'll get a $20 credit. Let's get started. Okay, Amanda Martin, thank you very much for joining us on the NZ Everyday Investor.
Hi Darcy, thank you very much for having me.
Fantastic. Now, not the first time on the show. For the benefit of those who are just hearing you for the first time, do you want to explain what is it that you do?
Well, I'm a tax advisor, and I advise accountants, lawyers, private clients and businesses on basically all things tax.
Last time we had you on this show, we were talking about capital gains tax, basically, and we were talking about the tree and the fruit. Mm-hmm. And in the end, that tax didn't go through, or so we thought. It didn't go through, obviously. And so this time we're going to be talking about 2 main things, really, which is the change in the bright line test, which some refer to as capital gains by stealth. Mm-hmm. And we're also going to be talking about the proposed changes to the interest deductibility rules around rental income. Mm-hmm. So just to start off with, Amanda, would you like to maybe describe to us what the current rules are with respect to the bright line test and what the changes are?
Sure. So if I just sort of backtrack a little bit, last week we had some quite significant changes announced by the government. It was a little bit like a bomb going off in our office. So you can imagine the sort of calls that we were fielding. In terms of the changes that we've got the current Bright Line test, and that was introduced in October 2015 by the national government. It was a 2-year test. So basically, if you sold residential land within 2 years, you'd be subject to tax. There is a main home exclusion for people's main home, and also there were some exceptions for inherited property or property that is transferred under a relationship agreement. Then fast forward, we had the Capital Gains Tax Working Group review, and then the Labor government introduced a 5-year bright line test. So for properties acquired on or after the 29th of March 2018, they are subject to the 5-year rule. So that's what most properties are subject to now in terms of when you're considering whether or not the Bright Line test applies. Then last week, it was announced that from the 27th of March 2021, there would be a new 10-year rule. In addition to that, they've also tweaked and changed the main home exclusion, so I can talk through how that's going to apply.
Yeah, that'd be good, because and going back to what you said around the exclusions, if it was, say, a relationship property settlement where there's a split and you had to settle up with your partner who was leaving and take full ownership, so that's exempt, right?
All of those. Well, basically, what happens is the transfer is ignored.
Sure.
So the parties get the original acquisition date for when they're counting how long that Bright Line period is now.
Got it.
And inherited property, if you inherit property, you're not subject to the Bright Line test. But that's it.
Right.
So this is a very blunt instrument. So think, bad times fall upon someone gets sick, someone needs to restructure their affairs, which means that a property needs to be sold. It's in, unless it's out under either two of those rollover reliefs or if it's the main home exclusion.
Right.
And the way the main home exclusion works, it was an all or nothing test. And so this is where, as long as the property is used predominantly, and that's a 50% or more than 50% test, for time and use, so area of the land, for more than half of the time that the person owns the property or the relevant Bright Line period, then that exclusion applies, so it's not subject to the Bright Line test.
Okay, so is this the area that would apply if one owned a holiday home?
Absolutely. So you can only have one main home. So actually, holiday homes are, you don't get the benefit of the main home exclusion
because
to a holiday
you literally have to teletransport within an exact 6-month time frame into the holiday home, so that it's exactly 50%.
And we look at, when we're looking at where is your main home, it's the place that you call home.
Logically,
it's where your stuff is.
Yeah.
It's where where your centre of life is.
Wherever you keep the majority of your underpants, that's your main home.
Exactly.
That's what we're saying. So anything outside of that, whether you want to call it your office or your holiday home or your city bolt hole, that's not going to apply for this main home exemption.
No, exactly. Okay. So in terms of, where we were at until Saturday, was that you were subject to a 5-year rule and it was an all or nothing test.
Sure.
In terms of where we're now going to, for where you've acquired property on or after the 27th of March 2021, and we talk about what does acquired mean. Well, it's when you enter into a binding sale and purchase agreement for purchase. For any new purchases, now you're subject to the 10-year rule.
Okay, and that would also, I'm just thinking about how this extends. So let's say you're living in your own home today, your main home, and you decide to buy a new home to live into and convert your existing home into a rental property, and you decide for tax reasons potentially to sell that property into a new ownership entity, whether it be a family trust or a company, then that 10-year start date starts from that change on that title.
Correct. So if anyone's thinking of moving properties around, you're effectively going to be restarting your Bright Line date, your start date, and you'll be forcing yourself into the 10-year rules. So I've had a lot of conversations with accountants and lawyers in the last few days.
I'm sure you have.
About potential restructurings that are occurring, and whether people should be moving their properties into different entities or not, and even things like, say you've got a family trust which is being wound up. Well, that's a disposal event, so that's going to restart the Bright Line date. So where previously it would have restarted for 5 years, it's now restarting for 10 years.
Sure. And this change that's come in was, in terms of the detail, or there's two things, I guess, that I looked at, was the consultation period.
Well, there wasn't any.
And then the level of detail.
Not a great deal. What they did do though was we had basically 3-page flyers which came out to us announcing what the changes were, and then the legislation has been rushed through, and received through a supplementary order, which is like the tack on you get to a bill right at the last stages. So they've tacked it on to the tax bill which was drafted and went through consultation last year. So this change to the Bright Line test and the main home exclusion, which I'll talk about, that went through under urgency, and it received its third reading end of last week, and is now just waiting royal assent. So the changes to the Bright Line rule are in place and law once we get royal assent, and of course that's just the rubber stamping exercise. There is one change which isn't in the legislation, and that is the new builds. So the government is clearly trying to encourage people to build more housing stock. So they have said that a new build will be subject to the 5-year test.
Yeah. Okay.
So we haven't, unfortunately though, we don't have a definition of what a new build is. So, we're already starting to rack our brains. Does that mean, what about bare land? Does that I might put new houses on? Does that mean a definition of a new build? What, say I've got a property which has got an old villa on the front, but I can subdivide and put a couple of new builds on the back, or put investment properties on the back. What is this definition of a new build? So that's we're going to be getting into the detail of that.
And this
through
is the
year.
part that I find interesting, right? Because whenever I've had conversations with my accountant about certain things, especially around changes like this, there's quite often a sense that the level of detail isn't sufficient enough for them to sufficiently answer my question. And that might sound odd. It would possibly be expected by most who are listening in that when these changes come in, it would possibly be assumed that they would be very explicit and that they would capture every little detail and nuance. But that's not the case. And this isn't the first time that that's not the case. When people are listening in, and by the way, we should also mention, but I know for sure, we should definitely mention that none of this should be relied on for tax advice. We often say, hey, don't rely on any of this content for financial advice, but triply sure today for tax reasons.
Definitely. Every circumstance is different, and you really should get tax advice on it if you are looking at how these rules affect you. Yeah.
So, and this is kind of, I guess, flowing on from the capital gains tax. Sorry, I just accidentally called it that for some reason. The Bright Line test. So flowing on from that, there's going to be people that naturally will want to fight it and try to figure out a way around it to avoid it legally, using entities like family trusts and companies, and making sure that maybe one party buys it rather than the other party to maximize the lower tax rate. There's going to be all that sort of stuff, but I guess there's a limit as to how much you can do, because you have to acknowledge the intent here is to decrease some of the demand side pressure on the housing market.
It's going to be really interesting to see how this plays out, because the intention is to encourage new builds. The intention is clearly to support first home buyers. But if everyone's going to be pushed into new builds, is that just going to push up the price of new builds? Investors can still buy new build properties if they want to. And also, what we need to be clear here is that the Bright Line test does not apply to people that are already taxed, or taxpayers that are already subject to tax. So your developers, your dealers, your flippers, your speculators, despite what was announced last week, investors are not speculators. If they're speculators, they're already subject to tax.
Yeah.
And they actually can get some better tax outcomes than a person who is subject to the Bright Line test.
This is interesting. So if you're a speculator who's pretending to be an investor, now's the time to stand up and say, actually, I really am a speculator. And because your tax treatment might actually be a little bit more favorable.
Well, you'll get the benefit of interest deductibility, and you get the benefit of some other holding costs which you might not otherwise be able to take as a deduction. And potentially you could also find that you might actually be able to get a GST refund. Obviously you have to pay GST on the way out, but it might well be that from a cash flow perspective you're actually better off just putting your hand up. Now, is that what the government wants?
It's hard to say.
It's hard to say, and I really don't know.
Who can know the mind of them, right? But I guess in the spirit of giving Caesar what belongs to Caesar, I guess it's all about making sure that we're making adequate provisions along the way. And what this does do is it shows us that not only can the rules change in an instant, but it shows the direction that the powers that be are willing to go and the extent that they're willing to go in order to solve a housing crisis. And I have to use these air quotes when I say housing crisis. But when they decide that they're going to solve this problem, they will keep on going until in their minds the problem is solved. So I think that we have to be pretty careful, I guess, when we try to sort of say, right, well, now I'm going to do this because this change has come in. That could be a trap.
It's interesting. If you read the regulatory impact statement from Treasury, they wanted a 20-year bright line rule, and then they put an option of a 15 and then a 10-year. And, their comment was, well, the government's already ruled out a whole lot of other taxes, i.e. capital gains tax, wealth tax, those sorts of taxes. So really this was the only tool in their toolbox. Now the government has come out and changed it to a 10-year rule. But, when we get talking about the changes to the interest deductibility, the Treasury, blatantly say in their feasibility, in their regulatory impact statement that they haven't had time. They don't actually recommend these changes, but, we've had some changes announced. I don't know whether it's scaremongering. I suspect it's not.
Right. There's two rules here. One is mildly uncomfortable but tolerable and understandable, and that would be the extension to the bright line test, right?
Well, and we all sort of knew it was going to come in. We absolutely had heads up. And just if I can just touch on that change to the main home exclusion. If you own a property before 27th of March, you're under the old test, which is an all or nothing test. More than half the time, have you lived in it as your main home, then the exclusion will apply. The new test, which basically requires you to do a day count apportionment for the amount of time that you have lived in it versus possibly renting it. And they are proposing that you are taxed on that proportion which you're not living in. They give you a 12-month window where you might be out of the house, or it might take you a while to move in, where that then doesn't force you into this apportionment.
Wow,
But certainly it is, it is a different test in terms of whether that exclusion applies. So say you own a property for 9 years and you have lived in it for 6 years and you have rented it for 3 years, you'll be taxed on the 3 years worth of the gain, apportioned, pro rata.
Got it.
So we don't look at, what's my value now? And that's where that's where you start thinking about the planning, because a person might say, you know what, I know that I'm not going to be in here for 10 years. What do? Do I actually force a sale to, let's see what the market price is? Am I better to suffer an apportionment over the gain, or am I better to lock in all my gain now and then just literally put my hand up and be subject to tax on the last 3 years?
Just to clarify, so I make sure I fully understand this. So you're saying over, say, a 10-year period, 3 of those years it was rented out.
Yeah, well, let's say 9, because if it was 10, we're not on those rules.
Up to and including. So 9 years, 3 years of which you rented out because you moved over to Australia. You're a builder. You wanted to get better income, whatever. Then you came back. You lived there for a little bit longer, but then you sold it at year 9. It was your main home for 66% of the time. So what you're saying is that based on the rules that have actually come into effect, then you would be paying capital gains tax for that portion of time that it was rented out for.
Correct.
A third of the time.
Correct.
Wow. Okay. And that's the law now. That's what we've
the law now. And under these rules, the way the law now is and the way the law was, you wouldn't get a full interest deduction. You get to deduct your costs of sale and capital improvements, etc. But you don't get the interest deduction for that portion of the time that it was your main home, because there's no business, there's no income being generated from it. So, and even then, when we look at the rental portion of it, we'd have to actually look at the purpose of the borrowing and that nexus as to whether we're enabled to take in a deduction.
So, in practical work, that might not actually happen where you do that, because the original purpose wasn't to buy it as a rental property.
Correct.
And all that sort of stuff
correct.
gets thrown in the mix. What about home and incomes, or homes which have a self-contained flat of some sort where there's income coming in? Does that change things with respect, firstly, to the change in bright line tests?
Well, that's a very good question. So it seems that the main home exclusion still has this 50% or more test. So that requires us to look at, it's an area and use test. So we'd actually look at, physically how much of the total area is attributable to the office part versus the home part.
Yeah.
If we're able to get over that threshold, it would seem that we still are able to rely on the main home exclusion, with the apportionment under the new rules.
Yeah.
So there are some other potential changes that might be happening in terms of the definition of a dwelling. We could go down a real rabbit hole here, so let's not go down that area. And there's a lot of work that's been done by the Revenue at the moment in terms of the definition of what a dwelling is, the definition of what residential land is.
Right.
Will add on here is that the Brightliner test that applies to New Zealand tax residents, obviously they're taxed on their worldwide income. So it also will apply to land that you own somewhere else in another country as well, if you're within that Brightline period. We look at everything globally.
You own some land in Bali, and you buy it like today, and then you sell it within 5 years, or 7 years, 9 years.
We will look to tax it. Obviously, Bali, Indonesia would have the right to first tax it because it's physically over there. But if they don't tax it, we will. If they tax it, then we still tax it, but we just pick up a foreign tax credit to acknowledge the fact that you've paid some tax in Indonesia.
Yeah. Wow.
So it really depends on how the overseas jurisdiction taxes it as well.
If you're a New Zealand tax resident, it doesn't matter if your property is within New Zealand or not. You're still going to be subject to these rules.
Exactly. So it begs the question, what does land in Bali have anything to do with property prices in New Zealand?
Apparently quite a bit. or nothing at all. Could be one of those two options. So that's the capital gains tax, and just, there's so much more that we can go into and so many little permutations here, and we'll kind of loop back to that a little bit.
Okay.
But I want to talk about the proposed, so that's done. That's a done deal. Now I want to talk about the proposed tax changes. Do you want to introduce
so the bomb that I referred to, this is what we were really...
This is the real sticky part of the bomb.
This is the really sticky part.
Yeah.
So for any business, and to date, we have been able to take if you borrow money to invest in a business, then you can take a tax deduction for all the expenses that you incur, which would include interest. For residential land, you would be obviously deriving rental income, you would have your loans, and you would be paying interest to the bank. So we look to tax the net income. Yeah. Now, a couple of years ago, I think from April 2019, the loss ring fencing rules came in. And this is where previously property investors would negatively gear. So the benefit was actually that you would end up with a net loss situation because your interest and other costs exceeded your rental income. And so you would use that expense, that net loss, against your other income. Quite often people would be subject to PAYE salary, for example. And so they would be able to get a tax refund.
So just to interrupt you here. So like thinking about this as a business, if you were to buy any business and you lost money, then effectively you're losing money there. Therefore, the principle is that the IRD doesn't want to punish you twice by taxing you to get that money to lose. You then go to the IRD and say, "I've lost money over here. Therefore, can you please reduce my tax bill because I've already lost it?"
Because it's one global pot. We look at all the income, and you've got some income that you've paid perhaps as a salary or other investments, and then you've got this other income, but it just happens to be a net loss
at the moment. Yeah.
Now, that was stopped, and we had these rules called the loss ring fencing rules, which essentially meant any excess loss, so that net loss that you got, you couldn't offset that against your other income. It would carry forward, and it could be used against future taxable income, and ultimately, if you still, after you end up selling the property, you could actually only offset and get value from those losses if you were in the land taxing rules. So if you're, say, for example, in the Brightline test or some other...
If there was a big tax bill due, but you had stored up losses, you could offset those.
Yeah. So last week, the government announced proposals that from the 27th of March for new properties. From October, there is no interest deduction for any new properties acquired. For existing properties that you own or have entered into contracts to buy prior to the 27th of March 2021, we will have a phase-in from October over 4 years.
Yes.
So after 4 years, after 2025, there is no interest deduction.
Correct.
So picture, say you've got, say you're earning rental income of $40,000, you've got $30,000 worth of interest expense, or then from 2025, or for new properties from October 1, there is going to be no interest deduction for that $30,000. So it effectively is going to be about a $10,000 additional cash flow cost.
Just to cover those numbers again, let's say you're bringing in $40,000 of rental income. Let's assume no other expenses, just to be really simple, and you have interest costs, not principal and interest, because principal has never been a tax deductible expense. So you have interest costs of, say, $30,000. That gives you a $10,000 profit. It's a very simplistic example, I know. Under the current rules, you'd be paying tax on that $10,000.
And say 33%.
Your marginal tax rate, whatever that is.
3,300.
Under the new rules, you're paying tax on $40,000, which is all of your rental income. Of course, adjusted for any expenses like rates, insurance, maintenance.
Yes.
But just simplistically, your tax bill doesn't increase a little bit. Your tax bill increases
a lot.
Significantly.
Correct.
A lot.
Correct.
Yeah.
So it's basically another $10,000 worth of tax that you'd be paying.
Sure. So you multiply that with, like the typical client that I work with will probably only have 2 or 3 rental properties. I primarily deal with mom and dad investors. But if you look at a portfolio of 20 properties, like some of these property investors will have, that is a significant impact when their lifestyle has probably matched their cash flow, and now there's this new thing. So it's a significant change, isn't it?
That's right. It's a really significant change. And the spin the way it was presented was that this is a tax loophole. It's not a tax loophole. It never was a tax loophole.
Where do you think that term loophole came from? Like, am I correct in assuming? Because I think about this as well. Maybe there's a PR firm employed somewhere behind the scenes that have been asked to use very interesting words to invoke emotion, so that there's a bit of a debate that's created, so that we appear to have more of a crisis. That's one thought. The other thought then is, maybe there's people in charge making these rules and writing articles about it that don't really know anything about business whatsoever. So it's got to be one of those two options.
Probably a combination of both, I suspect.
Right.
There is no tax loophole. It's we've already had the loss ring fencing rules, so we've already got a limitation. Where this comes from is basically people can buy property, they can leverage the property. So it's one of the very few asset classes that banks will lend on, and if the property is going up more than the cost of that borrowing, then they'll be in the money. There's no tax loophole in relation to borrowing money to derive income. That's not a tax loophole. So I don't really know where that language came from. Yeah. And one can only speculate. Right. But I felt quite strongly that it really misrepresented what happens. And,
Correct.
Sure, take Auckland for example. Yes, property prices have moved significantly, and if you look at an investor's return, the capital growth often outstrips the rental income, and really the numbers don't stack up too well. But look at other parts of the country where investors are providing accommodation for people that either one will always be renting their properties, renting accommodation. It might be students, it might be people that are trying to save to get on the property ladder. For those tenants, effectively, we're saying either in October if it's a new property, or from 2025, your rent's just gone up. Or the cost to the landlord has just gone up. And bearing in mind, we've just had a whole lot of changes to the healthy homes requirements, which I think is great. It's wonderful that we can improve our housing stock, but this is all costs that have been added. Yeah,
and I think a lot of people that, like, if you have no skin in the game, I'm just thinking about this from the perspective of someone who may believe that these tax changes are absolutely justified. This is fair, this is equitable, it's been out of balance for so long, therefore these changes are awesome. I'm loving it. If I put myself in that mind frame, which I've been trying to do a lot, like I'm kind of thinking about that as a bit of a form of therapy for me, which is probably really good, right? Like you try to understand the perspective a lot more. But I'm trying to think about what is it that they think, because often I suspect if you have, and then you're looking at the voices of the have-not, you're looking for flaws in their argument, just like they are the other way around. So there's this divisiveness that goes on. But if you ultimately try to get into the minds of the everyday investors who own a few properties, and a couple of them might be rental properties, they genuinely are, in their minds at least, they genuinely believe this. They don't just say this. They don't hate paying tax. They do hate how inefficient government is, and so they kind of feel like their job is being replaced by a really inefficient actor. Mm-hmm. That seems to be a common theme. They genuinely care for their tenants, as evidenced by like a lot of my clients who've gone well and above and beyond bringing their properties up to spec. Last year, a lot of my clients who were property investors gave rental relief to their tenants, which ironically puts them in a disadvantage now. So there's all these realities that actually happen, but then there's a narrative on top of that. And you mentioned the word, slightly maybe misrepresented by using that word loophole, whether it's on purpose or just because of ignorance. It seems to be presented in a way that feels a little bit like property investors are getting punished because they're wet, but it's pouring down rain everywhere. Everything's gone up by 25%. Why are we complaining?
Everything has. Yeah. And, if you're an investor, taking that $10,000 example where we don't get the deduction for the $30,000, you're still going to be taking a view and say, well, do I think my property is going to go up by more than $10,000? Can I fund this cash shortfall? Yeah. Or do I pass on some of that cost? And I think ultimately something's going to be passed on. And, I really feel that there's a lot of people out there that are hearing this messaging and perhaps haven't thought through what does it mean for them. And, for the... Say, for example, you've got a young family that have, scrimped and saved and now they can't afford to buy in Auckland, but their work is in Auckland, they have to live here. So they've gone and bought a property, say, in Hamilton or somewhere else in the country with the idea that they're scrimping and saving to try and buy their own home. Well, their rent cost has just gone up.
Yeah, no, that's the hardest part.
It's really, really tough.
With our couple of properties that we have rented out, quite often we have a high turnover in tenants because they are busy saving to buy their first home, and so it's kind of like a holding pen for them before they become property owners themselves, and I think that's pretty cool. But two things here. Like, I'm going to inevitably have to increase my rent. I have to. That's just a commercial thing. But the second overlay on top of that is that I'll only do that subject to where the market's at. So obviously it's not like we have these property investors who are colluding amongst themselves as a cartel to decidedly increase rents on a certain date. That actually isn't happening. What does happen is that, especially if you use a property manager, the property manager is actually just scanning the market to see what the market rent is, and you're slowly trying to move towards market rent.
There'll be a gradual creep. And, and I just should add here, we've got very little detail on what these interest deductibility rules will be, and there is going to be a consultation process, so who knows exactly how they'll come in. They have indicated also that interest deductibility will that there'll be a 5-year bright line rule, and there'll be more interest deductibility for new build properties.
Okay.
But my question is and I know they're putting in this big $3 billion infrastructure fund, but it takes time to build. We're running out of timber in the country. So
I can't get
how do we actually get this pipeline? So there is going to be these blockages all the way through and pinch points. So, in a perfect market, yes, we'll be able to build, 10,000 homes. But is that going to happen in time?
Yes. And
in time for rents to not go up,
Correct. It's interesting, meaningful market intervention. If there was ever don't even get me started on that discussion. I'm going to pull out of that one. But if we go back and just think about, there's two things here. The bright line test has definitely been extended. There is some sort of exemption for new builds. Then we have the loss in the ability to claim interest expense as legitimate tax deductible expense against that revenue. What other distortions do you think this will have? Like, I've got some ideas, and I've been thinking about this, and there seems to be quite a few. But what kind of are the other obvious distortions?
Just
that this
in terms
creates?
of other asset classes?
Yeah.
Well, it's really interesting, and I come back to when we did the capital gains tax review, the proposal was to effectively put everything in at tax at marginal rates. And if you look at the rest of the world, they have capital gains tax, other countries, but it's at a lower rate often. There's some exemptions. It's a softer entry than what was being proposed. And then obviously that was put completely off the table. But we have quite different rules that apply to, commercial property. If you invest in a global portfolio of equities, we have a completely different tax treatment than really anywhere else in the world. Yeah. We have a whole lot of other rules which apply to financial arrangements, so foreign exchange. So we've got all these distortions in our tax system, and I think you'll find that investors will firstly be taking a punt on, well, actually, you know what? You can deny me the interest deductions, you can push out the gain to 10 years, or even if you don't, I'm still better off investing in property if the view is the market's going to move higher than those once I build those net costs in. Alternatively, do I start looking at other types of investments? Or again, do I start looking at, well, where's the market? If I sell it, should I then be perhaps looking at rearranging my affairs?
Correct. So you wouldn't want to be selling probably right now as a knee-jerk reaction when everyone else is, because the market generally overreacts to bad news. But at the same time, you're probably thinking about, low interest rates for longer. That's now even more possible if there's these other overlays, fiscal and monetary, that keep things suppressed, paves the way for low interest rates for longer. Will the force of rising asset prices exceed the force of decreasing asset prices by the powers that be? And therefore, will I keep going? Or will I then look to, well, if I can't pursue it in the same way, maybe I invest in other things? Like, a question for you is, if you borrowed $500,000 not to buy an investment property, but you borrowed $500,000 to buy a diversified managed fund, would the interest cost for the purchase of that managed fund be deductible as an expense?
Yes, it would be. So, for example, if I borrowed $500,000 to invest in global equities, as an example, I would be taxed. I would get that interest deduction, and I would also be only subject to tax on, there's two methods, there's a fair dividend rate method or a comparative value method, but effectively, assuming no sale and purchases during the year, I'm taxed on 5% of the opening market value. That's my most that I would be taxed on. So, if I'd bought Tesla shares a year ago, over a year ago, then that's a significant movement in the price. Obviously, the markets go up, markets go down, but I could be looking to other asset classes if I thought that I could get a better return than what I can get on property. It's all a little bit, though, isn't it? Your ability to borrow money, and that's the piece that comes in, and also, I suppose, for the property, it's the supply side. Yeah.
I've been getting more calls from people even before this announcement, they wanted to borrow money to buy into investments, and that's a whole other podcast topic right there, because pros and cons all over the show. But if you can claim the interest as a tax deductible expense and you're getting 10%, and you're basically leveraging to amplify it, this is kind of like, yes, it's a way more volatile asset class, equities versus property, but it is more diversified.
It is. And, one of the messages from, when the statements came out was the government want us to invest in income-producing assets, businesses and other investments.
That's right.
They want us away from putting our money in residential property.
Correct. So whether it's some other investment that you're borrowing to buy into, or you're borrowing to put into business, which is kind of like, yes, that would be a very good outcome of this if it forced people to borrow against the value of their own home, perhaps, to put that money to work in their business, to buy more plant and equipment, to hire more staff, to be more whatever. However, the banks on the other end, they don't necessarily think like governments do.
Well, and this is the point, is that, and you will be able to speak to this obviously, is, banks like lending on property and residential property.
Yeah.
They don't really like lending on much else.
No.
And the banks have been really tough and will be even tougher, I imagine, in terms of the level of scrutiny that they need to go through in terms of serviceability.
Correct.
Before they'll lend. So, you can push everyone to invest in other assets, but until such time as the banks come to the party.
Correct. In other words, you need to understand who the players are in this economy. Business, property investors, banks. You actually need to understand their business models before you engage in meaningful market intervention, because you're going to lose meaning pretty quick, aren't you? And I guess if I was to think, right, well, if I was a bank, they have been extremely cautious. We've just come out of 12 months of on and off lockdowns. We're still in the midst globally of a pandemic. They're preparing for worst case scenario, as they should be. They're just trying to de-risk. The property market has caught them off guard, like it has everybody. They are already extremely cautious with respect to interest-only loans. So I have many property investors in the last 12 months that have had loans used for property investment that have had expiry dates approach for interest-only. They've had a change in personal circumstances, and they don't qualify for the current lending rules. And so what's happened, I have one investor who's gone down to a 10-year principal and interest loan on quite a significant amount of lending from interest only. At the same time, they've had a drop in income because of COVID. So
at the same time, the costs of maintaining the rental property have gone up and are going to go up even further.
Correct. So if somebody is clapping their hands by hearing that, if that is not tall poppy syndrome in full effect, I don't know what is, right? Like that's somebody's life that is effectively being ruined because of the sequence of events that's happened. And I don't think it's reasonable to say, hey, we want everybody to rise up in the country and have a fair go at the expense of pulling down these tall poppies. I just don't think that makes sense. Thoughts that you're allowed to say?
What am I allowed to say? I totally hear what you're saying, Darcy, and these changes here are to encourage first-time buyers, and that's great, but we can't forget everyone else. And also we've got to make sure that those pipelines, those shovel-ready projects, which apparently are to be done, some of them are years away from starting. Yeah. So how can we get the infrastructure there so that, for example, for the new builds, that they're actually able to be built? Yes. Otherwise, we're still going to be in the same problem. Is the property market going to go down or plateau, or is it still going to keep on charging up? And we're just hurting a whole lot of people in the meantime. Yeah,
I'd love to think that the third of households that don't own the home that they're living in, I'd love to think that it is their goal and their ability to own their own home.
Definitely.
But I know it's just a portion of that. It's just a portion of that 33% that can, will, or should buy their own home. They need to be housed somewhere. And if property investors are basically exiting as the government is taking over as landlord, I think that as much as most people with a bit of wealth want to contribute towards society, they don't want to be supporting something that's inefficient. They're wealthy for a reason, and it's not because of supporting inefficient things around them. So I think that it creates a lot of distortions for that first home buyer in terms of the numbers, but also on a macro level. If this gets implemented, it'll be nothing short of substantial in terms of its impact.
It will.
It's not going to be a minor thing. And I think because of that, and because people are aware of that, they're going to hold back, which further exacerbates that downward spiral in terms of expectations around pricing of houses and going down, all that sort of stuff.
Or, as I said before, you could find that people go, you know what, 10 years is a really long time. Actually, I'll just be subject to tax and that's fine. And I'm going to continue what I'm going to continue doing. I get my interest deduction. I'm taxed on the gain, and so be it. Because it's better than it wasn't, which is effectively your capital gains tax. So
which is all fun and dandy until they have a life-changing event and they have to sell, and then they really have to pay the tax.
Correct. What it really hurts is the is like your clients. It's the mum and dad investor that have one or two properties that are really, stretched themselves and are doing their best to build some wealth and provide a good rental property for another family. That's where this hits. So it's going to be really interesting to see how these rules play out.
Yeah.
There will be a lot of vigorous conversations, I suspect, going on because, as I said, all we've had is an announcement and a 3-page flyer that's come out. But, it was all ready to go and it was released at the same time as the Bright Line test. So they've obviously done quite a lot of work on it. Yeah. And it was clearly, it certainly didn't come out on the advice of Treasury.
Interesting. Okay. So if we were to think, what could they have done? We'll finish up on this because I think if we were to say, right, we're going through this period where there will be some consultation and there'll be some rigorous discussion. I'd love to think, actually, on that topic of consultation, just for people who are listening, what could everyday people do if they felt strongly about this and they wanted to say something? What is actually a constructive thing for them to do?
Well, in terms of the formal process, when there'll be a consultation period and then there'll be some draft legislation. And when the legislation comes out, there's an opportunity to make submissions to the Finance and Expenditure Committee.
Sure.
And so we have, the professional organisations, law firms, accounting firms, ourselves, we make submissions. But anyone can make a submission. Okay. There's a lot of property investor groups that will get together, I imagine, and make submissions as well. Yes. And really, I suppose you just need to be communicating how it's actually going to affect you and what does it mean for you. Yeah. So that will be happening soon, I imagine. They'll be releasing some proposals and some draft legislation, and because they're intending for these rules to be effective from the 1st of October. So it's the comment, we don't know exactly how it's going to work. It seems to be for new borrowing after the 27th of March. You'll be into this hard no deduction. Yeah. For existing borrowing on existing properties, you'll be in this 4-year phase out. Yeah. We don't know what it means if you refinance, if you switch banks, if you, all the kind of permutations that you go through in terms of structuring your loans. If you top up your mortgage or however you do it. But safe to say, the intention is ultimately to give no deduction. And we don't know whether there'll be any ability to claw back that interest deduction should you, say, be subject to tax on the Bright Line.
Got it.
One would hope there is some capacity to recover that cost if you're being taxed on the gain.
Right. Don't lose track of how much you've spent on
interest.
So
don't lose track. You've got to keep a running total of everything.
Yes.
So we would hope that there is some sort of capacity in there.
If we had a hot tub time machine, there'd be a lot of things I'd do with it, but if we had
sounds interesting.
It does. But if we had a time machine, we can go back in time to when, even just 12 months ago, when everybody was in the deepest, darkest pit of despair. What's going to happen? Everything's crashing all around us. If we can go back there and anticipate that this would have happened, we probably wouldn't anticipate the response of, because that's too soon. You'd think logically, right, well, 12 months, we're actually still in the midst of this. Too much too soon, right? Would you agree with that?
Yes, I suppose the extension of the Bright Line test was really always going to be on the cards. Yeah. Let's face it, the government wants capital gains tax, and they'd made the decision to say not on our watch, whereas really they could have said not on this first term. Yeah. So we knew that they were going to be looking to tax that. Yes. It does seem quite a harsh measure to deny interest deductions when they'd already implemented the ring fencing rules. So already there had been quite a big pullback on the ability and the cash flow consequences that you get from leveraging up a property. Yeah. It's just really, could anyone have anticipated the way the property market has moved? No. And ultimately, we need more houses. Yeah. That's the fix.
Yeah, and they're currently being gobbled up by just a few of us. That's the issue, and that is true, right? Like there is a very small minority that are gobbling up a lot of this housing stock when it becomes available, and for their own gain at the expense of those group of people that are just trying to move up. So that part totally makes sense, and I think anybody would agree that that is a problem that needs to be solved, and there is a mix of supply side and demand side that needs to be orchestrated. But what could they have done? Like going back in time when they were talking about capital gains tax, was that potentially a solution that could have actually gone through? That I can't believe it, but it actually sounds attractive now compared to this complicated setup.
They could have introduced a capital gains tax. They could have introduced capital gains tax not at the marginal rates, but perhaps at a slightly lower rate.
Yeah.
So it taxes gains, but perhaps not at the full, 30%. And now, obviously, from next week, we have a top marginal tax rate of 39% on income over 180,000.
That's right.
So they could have introduced that and actually put it across all asset classes. They could have, really, what are the levers that they could pull? Ultimately, they needed to, create more housing. We have had the pandemic, so we've had all these people coming back into the country that are looking for places to, one, to rent, but two, to buy. So there's been sort of a massive influx of money. The world's been printing money.
Yeah.
So, there's so many, I don't think anyone really could have anticipated where we've got to.
Yeah.
But they certainly could have done something other than just looking at the Brightline test.
Yeah.
And interest deductibility.
That's right. Because I think, from my perspective, I think that the banks were already performing a lot of this function. The central bank with reintroducing these LVR restrictions down to 60% for property investors, that is significant. And the last time this happened, and I think it was 2016, that had an immediate impact.
Absolutely. And so, have we seen the effect of that?
I don't think so.
No.
It's because it's scaling in. It takes a while for these bank approvals to run out. They're only just really running out now. And so there's this huge time delay. And it's only really, I think, these LVR changes that the Reserve Bank reintroduced is only really coming into effect now in terms of its impact. And so...
And then layer on, oh, by the way, your cash flow's just gone down.
That's my concern, is that it creates instability, right? It creates instability for investors, yes, but it also creates instability for the economy. I have $100,000 more tax to pay in 4 years' time when this... So that $100,000 from my household is $100,000 less going out into the economy.
That's right.
My car is crapping out. I was saying before, I'm probably going to get towed doing this podcast. I don't care because it's a piece of junk. But I need to upgrade it. I canceled the order on my new car. I can't do it. Oh, poor me, right? But that's just one thing.
But that's just money that's not going into the economy.
Yeah. And so you have this secondary impact where the multiplier effect now becomes a divisible effect, where it's not actually adding more money, it's taking more money out of the economy at an accelerating pace. And I'm not going to suggest that the government doesn't understand the economy at all. Of course not. But I think that if you're coming from this from an academic viewpoint, it's going to be a lot harder for you to really understand how these pieces work, because you have to understand the mind of business owners. And it's hard to understand the mind of someone else unless you have that person's mind. Common sense. So we're having this real interesting tussle going on, I think, where the government is moving in more and more, displacing to a certain extent those who are ambitious, kind of de-incentivizing them to climb up. And I wonder what kind of other aggregate effect that will have on just how innovation can occur in the country, because we're kind of, I don't want to say we're disincentivized, but it's a little less interesting for those who are ambitious to exercise that ambitious because of the attitude that we're starting to sense.
Well, it's very much Big Brother, isn't it? And I think people will be a lot more cautious, and particularly regarding purchasing investment properties that are not. People will probably spend more money on their own homes.
I think so.
Will there be this lock-in effect?
I think so. I think people will sell their rentals and just buy luxury homes.
Well, exactly.
Why not? You don't have to deal with tenants if you can afford it, right? So we're talking about a very small sliver of society. But let's say you are the mom and dad investor and you've got a couple of kids and you really want the pool. Let's not spend the money on the pool because we can't even get timber right now. Let's actually just sell our 2 rentals and our home and just buy this massive Remuera mansion. Because we can, and hey, it actually comes out so much easier.
Exactly.
So I wonder if that'll create little bubbles in those.
I think
those
there
assets.
will be little bubbles in different asset classes. It'll be interesting to see what happens with
new builds as well.
New builds as well.
Yeah. Because if everybody's playing in that space,
well, it's just going to push the price up.
same bubble, just different pot.
Exactly.
And yeah.
It
it
creates work, I suppose, for me. But,
That's true, yeah, that's true.
But, you need to be, people need to be thinking carefully about what rules they're under, what they're going to do personally, and the way the changes to this main home exclusion works, because that's going to affect someone's decision. Do I take the 2-year posting to Dunedin? Yeah. If it means I know I'm going to be selling my house within Brightline, suddenly there's an extra cost there.
Yeah, that's right.
And my rent in Dunedin's probably gone up as well. Yeah. So there's a lot of things going to be at play here. And it's just going to be a really interesting 6 months to see actually how the rules pan out in the end, and whether there'll be any softening on what's being proposed. Maybe is this just the
job
scare? Maybe this is the job, that they wanted, just to scare the living daylights out of everyone.
I certainly hope so. It's definitely scared me. I'm not going to buy any property, I promise.
Yeah.
I promise I won't tell anyone else to do it either. But maybe that is the idea. Maybe it's like a big stick, and then the smaller stick gets pulled out right beforehand.
But, we've had the Brightline test. We had, 2-year, 5-year. Has it worked? It hasn't.
I'm not sure.
Yes, we're going to get a bigger tax take.
It just forces people to hold on to property for longer, which stops more stock from entering the market. So if you're now extending that to 10 years, there's investors who have just signed up to a property this weekend. Well, they're probably going to want to hang on to it for even longer. So now you're creating a situation where you're taking liquidity out of the market, not putting new housing stock into it. So that's what I've seen anyway, from when the 2 years turned into 5 years from the Brightline test.
People just held on.
Yeah, which is good practice anyway. So I kind of look at that as, well, that's actually good, because you shouldn't really be investing in property unless you have at least a 7-year time frame, and you've actually done some modeling around what are your risks around interest rate, job loss, personal risk, regulation, including taxation. If you've done some due diligence around that, then you should be okay. And I think if anything, this is just a reminder to anybody who is looking at property investment or any investment tool. We don't just play with tools and see what we can build with it. It's part of a strategy, and you need to actually sit down with an architect, like sit down with a financial advisor, sit down with a tax advisor, especially at the moment, right? Try to understand, are these the effective tools to build what you want, and what are some of the other considerations? Because it's now not as simple as it used to be. So much more important to get advice, right?
That's right. And so often I see people too late, or they're just about to settle on a property. And quite often we can, come up with a really good strategy if we are talking to clients early.
Right.
And, the days of coming up with fancy tax avoidance arrangements, they're gone. Every now you have to be really careful, really prudent, understand what the rules are, understand where you sit, and you just need to play it carefully and smart.
I think so. Yeah.
And if you're not doing that,
Yeah.
well, that's when you get yourself into trouble, and people, really can get themselves into a whole lot of trouble if they don't take advice from your financial advisor, your accountant, tax advisor. Make sure that your lawyer's up to scratch on what they're advising as well.
And one of the most destructive things I've seen is people who are trying to cope with and deal with an unexpected tax bill. And you could say, right, well, I'm angry at the IRD for this, but really, if you go back in time, did you really seek out advice, or did you assume that people would tell you what to do? Don't make the assumption that someone's going to tell you what to do. Like, even if you have an accountant because you're self-employed already, but you own a rental property, don't assume that they are proactively looking at your file all the time and will be contacting you if there's something you need to know about. They've got 100,000 other clients to deal with.
You need to and you really
do it.
have to be on top of it and take the responsibility on board.
Yes, yeah. So, and your role is to be a secondary advisor, I guess, to these people who are providing initial advice to consumers. So how do you think this will affect your business? Because I suspect that a lot of tax advisors are probably still struggling to understand how this works out, right?
Well, we've been fielding a lot of calls already from accountants and lawyers to try and understand how these rules affect them. I anticipate we're going to have a reasonably busy next 6 months as people try and sort of digest and understand what it means for them.
Yeah.
So I advise, accountants, lawyers, private clients, other investors.
Yeah.
So
Okay.
in terms of how these rules are going to affect them. So I imagine we'll be quite busy with these rules. And, these rules did come as quite a surprise, and they will absolutely add compliance cost on, just like the loss ring fencing rules did. So again, it just adds a lot of cost for taxpayers.
Yes. If it achieved a good outcome, awesome.
Yeah.
I think everybody would agree with that. It's just this suspicion that all of this compliance and extra cost isn't actually going to achieve a good outcome. I think that is the core issue, right? When you boil it all down, you either believe that the government is competent in this space to solve this so-called housing crisis, and this will be helpful for that. And if you believe that, that's awesome,
fine.
and I hope that happens. But on the other side, if you don't believe that, there's really nothing else you can do. You're in the system.
You're in the system, you're in it, and don't
try to fight it. Yeah.
Don't try to fight it, but just be smart about it, and make sure you've got all your ducks in a row, and you're thinking about how these rules are going to, all these potential changes might affect you when you're borrowing more money, when you're looking at restructuring anything.
Yes.
You just need to be tread carefully, because a lot of people just assume, I own the property, but they may have actually transferred it between taxpayers, or they may have, done something which has actually triggered a disposal event. The worst case scenario is where you've actually effectively created Brightline income, but you haven't really sold the property. You haven't got the cash. You've just moved it around.
So now you got to go back to the bank and ask for a top up on your mortgage, which they might be reluctant to give you for tax reasons.
Exactly.
So,
and you don't even know which way the market's going to move. So it might well be you've paid tax on income, and then you've got something that actually goes the wrong way.
Wow.
So, who knows what's going to happen with the property market out of this. It'll be interesting. Hopefully it has the desired effect.
Correct, yeah.
And
with minimal collateral damage.
With minimal collateral damage.
Yeah.
And who knows, National have indicated that they would look to repeal these. Yeah. Certainly the interest deductibility rules, and they're talking about taking the Brightline back to 2 years. Whether that's a good idea or not, I'm not convinced.
Yeah. Well, I think in light of all these changes, like give me capital gains tax every day and just take away all this other
it would make it
stuff.
a lot simpler.
Just scrap all the FIF, FDR, CMV.
It would make it a whole lot easier, and it would also make it easier for people that are coming in from out of the country. We get these massive inconsistencies from a New Zealand tax perspective to overseas.
Well, you just look at Google Maps and you look at how our roading has been developed over time, and you realize pretty quick that that's the same type of mentality that's applied to infrastructure usually, is that we'll just set up a connection between these 2 points, and later on we'll connect those 2 points up. But there needs to be a substantial renovation on the infrastructure in terms of tax. Like, is that on the cards at any stage, do you think?
I don't think so. It would be good if there was, but that would involve an enormous rewrite of the law. The revenue, the policy advisors, they've got a huge list of things on their to-do list, and really this is a little bit being politically motivated. So
a little bit.
Who knows? But certainly anecdotally, a lot of people are coming to us and saying, why don't we just put in capital gains tax? Yeah. Now, I'm not necessarily saying that's a good thing or a bad thing, but...
Let's go back to that other podcast and then people can find out for themselves what they think.
Go back and listen to that one.
Yeah, awesome. Well, we've covered a lot of ground. So we've covered the change in the bright line test with the capital gains tax. We've talked about the change to the not loophole rules of being able to offset your income from any expense, specifically interest in this example. And then we've talked about some of the side effects and potential workarounds or not, and what people should do. So again, I'd encourage anybody listening to seek professional advice from a multitude of advisors with respect to any decisions around property, especially at the moment. Amanda, if people want to find you, what's the best place for them to find you in terms of social media? Would LinkedIn probably be the best?
Yeah, LinkedIn is a great place. So I will be. You can just search me up on that, and that's a good spot. On
Hey,
social media.
are you on Clubhouse? Do you know what Clubhouse is?
No.
Well,
is this a new place?
This is a new place that all the cool people are there, Amanda.
Oh, I want to be there.
I'm going to send you an invite, and anybody who's listening, just hit me up on Messenger, and I'll send you an invite as well. It's a new social media platform, Twitter plus LinkedIn, sort of, plus podcast, mix it all together. That's what Clubhouse is.
Clubhouse.
So with any luck, Amanda, I'm going to convince you to be there next week, 3 days after this podcast is released, if possible, so that we can have a discussion and maybe even answer a couple of questions.
Okay.
Sorry to put you on the spot, but how does that sound?
That sounds like fun.
Now you have to learn more about what Clubhouse is and have an iPhone. So awesome. Well, thank you very much, Amanda. Really appreciate your time.
Thanks for having me, Darcy.
Awesome. Thank you.